Good morning and welcome to Business Morning. I'm Ladi Williams.
And I'm Chimeze Obi Iwago. Thank you for joining us. Well, we'll begin with yesterday's Federal Executive Council meeting where a sum of over 26.7 billion naira was approved for contracts to be executed by the Ministries of Communication, Water Resources and Information and Culture. The projects include 8.43 billion naira for the Damaturu Water Supply Scheme, 8.9 billion naira for an ICT part in the nation's capital, and 9.43 billion naira to complete Nigeria's digital switchover. Let's listen to this report.
Nigeria's highest decision-making body, the Federal Executive Council, holds its weekly meeting with the President at the State House in Abuja. This time, a total of over 26.7 billion naira is approved for projects, beginning with the first of its kind 4,200 square meter ICT park to be situated in the nation's capital aimed at tackling unemployment and employability.
It will be a center where technology is going to be developed and incubated. It is also going to be a center that will play a significant role in reducing the rate of unemployment in Nigeria and address the gap that has existed with regards to unemployability. And this is a good news for our youth. Particularly, we plan and hope that Abuja is going to be another Silicon Valley of Nigeria.
Nigeria has so far missed 2 deadlines for the digital switchover. With the approval of the memo presented by the Minister of Information and Culture, that switchover should be done soon.
The effect of the memo of today is that the digital switchover is now real, and the economic effect of it will be the creation of hundreds of thousands of jobs in content production, channel distribution, Nollywood, and electronic appliance productions to service the over 20 million Nigerian homes. At the end of the DSO, we will have created the biggest free-to-air TV platform in Africa. I will be announcing a ministerial task force that will execute the council resolve, very soon. If not this week, next week.
Council approved a national policy on aging to protect the rights and interests of the elderly in the society. It also approved a 21-year memorandum of understanding between the Information Ministry and the CBN Bankers Committee for the renovation of the National Theatre in Igomu, Lagos. The Bankers Committee is willing to invest 21.8 billion naira into the project. From the State House in Abuja, Kayla Megwa, Channels Television News.
And the Federal Executive Council also approved a new medium-term debt management strategy for 2020 to 2023 to reflect current economic realities and incorporate data from the revised 2020 Appropriation Act and the medium-term expenditure framework for 2021 and 2023. Under the new borrowing guide released yesterday by the Debt Management Office, the federal government put the total public debt ceiling at not more than 40% of the gross domestic product in order to accommodate new borrowings and to fund budget deficits and other obligations. Prior to the current strategy, Nigeria has had 2 medium-term debt management strategies. That's between 2012 to 2015 and 2016 to 2019.
In the meantime, the Speaker of the House of Representatives, Femi Gbajabiamila, says the House will focus on bills and motions in the 2021 legislative year that will unlock economic potential by removing restrictive and predatory regulations and improve the ease of doing business. This is coming in response to the controversies which trail the central bank's directive to banks to stop transactions in cryptocurrencies. The Speaker says the move by the CBN deprives young people the opportunity to conquer new frontiers in an era of technology and innovation.
In the 2021 legislative year, we will focus the attention of the House of Representatives on bills and motions that improve ease of doing business and unlock economic potential by stripping away restrictive regulation and ending predatory regulatory practices that deprive our young people the opportunity to conquer new frontiers in this age of technology and innovation, of daring and enterprise. We cannot risk implementing policies that handicap our ability as a nation to participate in new markets and profit from emerging industries.
Well, taking it from what the speaker, has said, talking about this cryptocurrency matter, I guess it's time for regulators, of course, to begin to look into this. No restrictive policies there. Now, if you would, I listened to Janet Yellen, and this is what she has to say. She's talking about, she said, and I quote, cryptocurrencies hold promise, but were too often used for crime. Recognizes that fact. But then he says new financial technologies could help fight crime and also reduce inequality. And according to her, she said, we will modernize the Treasury's approach to dealing with financial crimes. Okay, so I guess it's time for regulators. I mean, this is the
ways on how we can actually profit
from this
financial markets,
because this is the new way.
Exactly.
And this morning I was listening to Bloomberg TV. MasterCard has actually backed cryptocurrency.
Exactly.
So, I mean, this is the way the world seems to be going now. So I guess it's time for the regulators, instead of coming up with this restrictions and all of that, to look at how they can maximize the potentials of this market.
Let's not fight it. Let's understand it. Meanwhile, the Senate has confirmed the nomination of Mr. Bello Hassan as the Managing Director, Chief Executive of the Nigeria Deposit Insurance Corporation, in line with the request made by President Muhammadu Buhari on December the 18th, 2020. This follows the adoption of the report of its Committee on Banking, Insurance and Other Financial Institutions at a plenary yesterday. Presenting the report after screening, Senator Uba Sani says the committee found Mr. Hassan worthy of the appointment due to his experience, pedigree, performance exhibited during his first tenure of office. The upper chamber also approved the nomination of Mr. Mustafa Muhammad Ibrahim as Executive Director, Operations, and two other nominees as Executive Directors for the NDIC.
Okay, the National Bureau of Statistics last week released the capital importation data, which showed the total value of capital importation into the country declined drastically, standing at $1.069 billion in the fourth quarter of 2020. That represents a decline of 26.81% compared to the third quarter of 2020, and a decline of 71.87% compared to the fourth quarter of 2019. Well, to discuss this further, an investment analyst at Codros Asset Management Limited, Akintoye Oyelaku, joins us next.
And Mr. Akintoye Oyelaku joins us now. Glad to have you on the show, Mr. Akintoye.
Thank you very much. Good morning.
Good morning. Thank you for joining us. Recent data by the National Bureau of Statistics showed Nigeria's aggregate capital importation fell by 59.6% year on year to about $9.6 billion in 2020, representing the lowest since 2016. What can you make of this data?
All right. The decline that we saw in capital importation was slightly unsurprising, especially if you consider the negative impact of the coronavirus. So after we recorded some few cases of COVID-19 in Nigeria, foreign investors' reaction was to sell off their holdings in the financial market to exit the market. While some of them were able to exit the market, a lot of them were locked down as a result of the FX rationing by the CBN. So what we saw was that at the investor and exporters window, we saw drastic decline in FX supply in that space. So a lot of those foreign investors were tied in. So the positive impact was that we didn't see as much deterioration in the external reserve as we should have seen if the CBN had allowed the foreign investors to exit the market. So, however, the negative impact has been that foreign investors' sentiment towards the Nigerian economy has now been worsened. So the reflection of this was, what we had in the second quarter. We saw a plunge in capital importation. And also, although we saw a marginal uptick in the third quarter, in the fourth quarter, again, we saw another decline. So another major contribution to the capital importation decline that we saw was the oil price crash due to weak demand, So because of the fact that most economies had to implement lockdown measures, travel restrictions, and the like. So we saw that, since people were not moving, there was no activities, there was less demand for oil. So oil demand plunged, and the price also plunged, to historic low of around $15 per barrel. And this was the major driver of that sharp decline that we saw in capital importation figure in the first quarter of in 2020.
More specifically, there was a major contraction in all components of the FPI, with the money markets and equities market recording sharp declines of about 69.91% and 60.1% year on year. Now, I know that in the past, FPI make up the largest amount of capital importation, but this time it's other investment followed by FDI. Just wondering what changed the narrative.
All right, so the foreign portfolio investment still dominates in terms of when you look at the total inflows. I think it still contributes around 58% to capital importation. So, but what drove declines in FPI is, in addition to what I said earlier, due to the emergence of the COVID-19, what we saw was that central banks, were trying to hold easy monetary stance just to support sharper recovery for their economies. So we saw the yield on the interest rate environment drop very significantly, and this affected, investor sentiment. Generally, it is expected that if risk should increase, return should also increase. But what we had in 2020 was the reverse. We saw increase in risk, and we saw yields on investment instruments falling significantly. For example, the Treasury bills instrument averaged below 1% in the yield, while for the bond segment, we saw average yield on domestic bonds falling between 3 to 4%. So if you compare this with the level of inflation that we had in 2020, for instance, in December, we had around 15.75%, while for November, we had around 14.89%. On the average, we had double-digit inflation in 2020. So this affected foreign investor sentiment. If they invest in the financial market, they are automatically going to be having negative return given the high level of inflation. So the level of yield environment was not compensating foreign investors enough for the risk that that we need them to take to bring in more effects. So that's the reason why we saw a sharp decline in the component of the FPIs. So for the money market and the bond market, we also saw contraction in capital importation for the equities market, largely due to the liquidity challenges. Investors were worried about if we bring in our dollars, are we sure we'll be able to, also easily move them out of the country in case we need to do so. So these were the major contributors to the sharp decline that we saw in the FPI components.
Okay. With the new debt management strategy approved by the FEC, how would that support investment, particularly the FPIs?
All right, so the major factor is that investors are expecting that there should be a compensation for the level of risk that they're taking. Recently, we have seen recovery in oil prices, and this will continue to support foreign investment. However, the major challenges we have is the fact that the view on the Naira, the expectation that there's going to be a devaluation soon, also the interest rate environment, although we have started to see an improvement in the yield environment, but it is still low compared to the pre-COVID levels. Also, although we expect that the CBN is still going to tighten, the interest rate environment, it depends on the level of compensation, the level of yield that these foreign investors can get on this instrument. So that's what will actually drive, foreign portfolio sentiment going forward in 2021.
Now, looking at the primary market auction yesterday, how do you think that would form the outlook for that market going forward in terms of the yield?
All right, so what we saw at the primary market auction yesterday was that there was an improvement in average yield. We saw 364-day instrument, trading at around 4%. So what Signal is sending to the investor generally is that there's expectation that yield environment will continue to rise. Although in the first monetary policy meeting that was held this year, we saw that the CBN maintained all key policy rates. However, given what we have been seeing in the OMO auction and the T-bill segment, I think there's an indication that we'll continue to see an improvement in the yield environment. And this will be positive for foreign investors and for capital importation going forward.
Okay, considering the capital importation data and the current FX liquidity challenges, do you see the central bank devaluing the Naira yet again?
Yeah, so the major view by the public is that Naira is currently overvalued. In 2020, we have seen gradual adjustment in the domestic currency at the I&E and the official window. And looking at the FX measure, although we have been seeing improvements in oil price, and we expect this to continue on the back of the vaccine rollout. This will be the major potential impact is going to have. So if yields continue to rise, we are going to see more inflows for foreign investors, especially if it's enough to compensate them for the existing risks that are prevalent in the domestic market.
Okay, now, what is your outlook on inflation, and how do you see this affecting foreign investor sentiment?
All right, so the general trend in 2020 has been that we are seeing a sustainable trend in inflation level, and this was due to the border closure in 2019, the land border closure, and also we saw that at the latter part of the year, we saw the regulation of PMS and also the power tariffs. So all these are going to likely have an upward pressure on inflation levels. However, we expect also the high base effect in 2020 and the recent reopening of borders to ease the rate of growth in inflation. So we expect inflation to continue, higher, but at a slower pace. And what the impact will be on the foreign investor is that if yield is still highly dependent on what the yield environment is like. So if the yield environment is high enough to compensate them for the exchange rate risk and the inflationary the inflation risk and other risks that are present in the domestic economy, we are going to see more inflows from foreign investors in 2021.
All right, thank you very much, Akintoye, for your time. We do appreciate it. Okay. We take a break, and then when we come back, we look at commodities market update as Dumebi Iyeke, one of the research analysts with financial derivatives, joins us next.
Let's take a look at the global oil market update. Brent crude fell 39 cents to $61 a barrel after touching its highest since January 2020 on Wednesday. U.S. crude slid 35 cents to $58.33 a barrel. Brent has risen for the previous 9 sessions, its longest sustained period of gain since January 2019. And Wednesday was the 8th daily rise for U.S. crude. However, some analysts say prices have moved too far ahead of the underlying fundamentals. Top exporter Saudi Arabia is unilaterally reducing supply in February and March, supplementing cuts agreed by other members of the Organization of the Petroleum Exporting Countries and Allies, known as the OPEC+.
Okay, let's look at domestic commodities market update. Of course, we have here with us Dumebi Iyeke, research analyst with financial derivatives company. Dumebi, good to see you. Good morning.
Good morning.
Thank you for joining us.
I guess today on your burning economic issues, we'll have to start off with the Naira staying at 400 Naira per dollar, resistance level at an I&E window, and appreciating the parallel market. So how will this affect the domestic commodities market in the near term?
I mean, first of all, let's look at the context for 2021. 2021 is a year where several analysts are expecting that things would be a lot better than 2020. Yeah. Well, their expectations that the domestic economy would recover, but it's going to be slow, gradual, and very tough. The Naira would receive some respite, but there will still be currency pressures. Inflationary pressures would persist, even though we expect that it could taper, from Q3 once the harvest season commences. So generally, 2021 is a year for a significant increase in, several leading economic indicators. At least that's the expectation, on the premise that the several risks that we're looking at in terms of the spike in COVID cases and the pullback on reforms, those are the major risks, to all of this outlook, and possibly, another repeat of what happened in Q2 2020 with oil prices. So those are the major risks to what could happen in the domestic economy in 2021. Now, bringing this to the naira, we've seen that the IFX window has reached its resistance level, which is 400, which it actually surpassed 2 days before to 401. Meanwhile, the parallel market has appreciated to 478 as of yesterday, after trading consecutively for about 5 days, at 480 naira per dollar. So generally, we're seeing some movement in the IFX window to bring it closer to the parallel market and the official rate. So we're seeing some exchange rate convergence. How will this affect domestic commodity prices? We'll have to look at how this affects the manufacturers firstly, because the IFX window is where most manufacturers get their forex, to import raw materials for the production of domestic commodities. So if there is a level of volatility in the market, in the forex market for them, it simply means higher import costs. But clearly, we're seeing that there's an increase in forex supply by the CBN, and this is helping, the naira to appreciate. So naira appreciation means a lower level of import costs for these manufacturers, which will in turn reflect in their operating costs and generally prices. But we're looking at this on a very temporal play for the meantime.
We're still looking at the exchange rate. What is your outlook for the I&E window and the parallel market going forward?
Definitely, we still are expecting some level of currency pressures, especially with the fact that the CBN still has a dollar backlog to clear, dollar demand backlog to clear. There's heightened demand for forex right now, especially with the fact that economic activities are resuming, and are taking a huge pace, especially with the resumption of, the commencement of the African Free Trade Agreement and the border reopening. So there is an increase in business operations and economic activities. Even some students, international students are, resuming school already. So there is an increase in forex demand, actually. So all of this put together with the shortage in forex supply is going to continue to intensify currency pressures. And we could see the IFX window move past this resistance level again in the coming term, and parallel markets as well.
But then the central bank is expected to increase some kind of forex supply in the market. So what will be the immediate impact on the price of food items?
Definitely an increase in forex supply means that there is some level of cushion to those who are demanding for forex. So they are meeting their needs. And if they're meeting their needs, we could see some level of stability in the naira just for the short term. And this, would reduce the effect on commodity prices, especially imported commodities.
Now, I mean, the central bank, the IMF, they've been going back and forth the issue of devaluation of the naira. So with this trend that we're seeing now, I&E window 400 naira to the dollar, and then the parallel market 470. And do you see, that gradual convergence coming, and perhaps we having some kind of devaluation in the near term?
I mean, with what we're seeing from RENCAP and our own PPP, that's purchasing power parity analysis, we've seen that the naira is overvalued at least by over 20% already. So the fair value of the naira, according to RENCAP, is about 499, while from our analysis, the fair value of the naira or the PPP value of the naira is about 507 naira. So meaning that the naira is overvalued currently. So putting this together, there could be there could be a devaluation of the naira. The EIU expects the naira, the official rate of naira to be devalued again to about 450. But generally, we really don't know what cards the CBN is going to play at this point, since now they've openly come out to say that they're not going to accept the IMF's recommendation for that devaluation on the risk that's going to stoke inflationary pressures. But what we'd likely see is that the convergence will continue, to to unify the exchange rates that we currently have. So we'll continue to see that process of convergence continue. The IFX window rate, the IFX rate could, move past its resistance level, and the resistance level itself is the upper level for which the IFX rate, shouldn't cross or should cross. So, and that resistance level is 400, and we've seen it go past it just this week. So we could see that happen again. That's basically what we're looking at.
Okay, looking at our gross external reserves, depletion has continued, and reserves are currently below $36 billion. What does this mean for the economy and the commodities market?
Earlier in the year, we were looking at, alongside a lot of other analysts, we were looking at the fact that the gross external reserves will receive a temporal boost as oil prices increase, and we saw that happen in January when the gross external reserves increased to over 36 billion, just to about 36.8 about thereabouts. So right now, we still believe that the depletion is going to continue, and it could go to about 35.5, especially looking at the fact...
Right now we're seeing oil price going up, even though this morning
oil price,
the price of oil came down, but then it's still high, back to its pre-pandemic
levels. So that would give the external reserve a temporal boost. But we're expecting that as the CBN meets up with his Eurobond maturity, as the CBN intensifies its efforts to keep the naira stable, there would be some level of depletion in external reserves, and that's going to continue in the near term. So the temporal boost definitely would come when, it's going to continue it's going to happen when as oil prices maintain its rally.
Yeah, I haven't seen this oil price perhaps maintaining its rally, even though this morning it tapered a little bit, but still above the $60 per barrel. And then looking back here, of course, the government is talking about the possibility, to increase the fuel price. That's an issue. I mean, Labour would not want to hear. But how do you see this playing out, considering the fact that I don't think the government will have to go back to the subsidy, regime.
Yes.
So how do you see this playing out?
Okay, so let's start with the fact that there are a couple of reforms that are already taking place, including the removal of fuel subsidy, the PMS price regulation, the cost-effective tariffs, and we do not see this. We do not see the federal government and the CBN pulling back on these reforms anytime soon, especially with the fact that this would also keep the CBN, even though the CBN doesn't want the value, but at the same time, this would bring some harmony between the CBN and the IMF and keep the economy in a very positive light in the global space, especially in terms of credit rating and all of that. But generally, we've started the process, and this is what's going to keep happening. The more global oil prices increase, that's the more we're going to keep seeing PMS price rather increase. So the only issue would be that the fiscal authorities and monetary authorities would have to, give the economy or Nigerians in little doses, so that there is no pushback, from the people in terms of,
already inflation,
social unrest and all of that.
Galloping,
exactly, because people, their income is not increasing, so people are already embattled in some type of way.
Okay, looking at gold now, global gold prices are also rising, and investors anticipate a prolonged rally in the global economy. How will this affect the Nigerian economy?
Definitely, first of all, there is an inverse relationship between the value of the US dollar and safe haven assets like gold and silver. Once there is a weakness in the US dollar, we would see investors move towards safe haven assets like gold and silver, and that's exactly what played out for the price of gold as of yesterday and a few other days that we've seen gold trade at very high levels, even silver as well. So currently investors in the global space are looking at a prolonged rally for the global commodities market, and not just only for gold but other commodities. And if this happens, commodities that we are import dependent like wheat, corn, sugar, as their prices increase based off of this expectation of analysts, as their prices increase, what we would likely see is an increase in the import cost for these commodities and other, related commodities from these global commodities that we import, like wheat, corn, sugar, we could see their domestic price increase. So, but a commodity like cocoa that we export, that just simply means an increase in export earnings for us.
Okay, let's look at the domestic commodities price movements there. Can you take us through that and what possibly driving them?
Right now, we're still seeing a decline in prices of several commodities like tomato, rice, pepper, onions, and that's because of seasonality. Although for rice, we're seeing an increase in the supply of rice, especially with the border reopening. So that's, providing some support for the price of rice. For tomatoes, during the dry season, it thrives. There's ample supply, so that's why we're seeing the price of tomato decline. For pepper as well, we're seeing the same thing. For onions, the same thing. A commodity like yam, we're seeing that the price of yam is still about 1,000 naira per tuber in some places. Some places about 800, 900. So generally, right now, the price of domestic commodities are relatively cheap compared to December last year or even November. But we're still looking at the fact that as the year progresses, when seasonality, takes its toll, when the planting season commences, and there's an increase in, consumer demand for some of these commodities, especially with the fact that coupled with the fact that there's also insecurity in the major food belt, we could see domestic commodity prices increase significantly, and this definitely would not be a very good news for consumers.
Definitely not.
All right, thank you very much, Ed. Maybe always a pleasure.
Thank you so much. Thank you.
Thank you. We'll take a quick time out and we'll be back in a moment. All right, let's talk about our local markets there. And Eddie, of course, is on board. Eddie, just wondering, looking at the primary market auction yesterday, just wondering if there is any hope of the bull coming back to the equities market.
Well, Chimi, I do not know. I know the primary market auction, we saw yields increase across all tenors yesterday. So that may be good news for investors in the fixed income space. For the equities market, I'm not so sure about that. But hopefully, with the declines we saw yesterday, investors may just want to take position in the markets because we saw huge declines from Dangote Cement and Tier 1 lenders. So, Chimi, this is the time to actually buy some stocks now that the prices are really low, so that when they start increasing, you would have at least made some profit in the market.
It's called buying the dip.
It's called buying the dip. But well, today I decided to dress in the color of the market because if you can't beat them, join them. So I'm in red because the market has been red and it's really, really depressing. But let's talk to Tajuddin Olainka, a stockbroker at Valmont Securities, to get a sense of what really happened in the market yesterday. Good morning, Mr. Olainka. Thank you for joining us on the program.
Yeah, good morning. Good evening.
Now, we saw deeper declines in the market yesterday, especially on Dangote Cement, which was down by about 7%. What was responsible for that?
Well, the decline was not restricted to Dangote Cement. It cut across. We saw more stocks losing than the fewer stocks that gained. And so that suggests that the market was extremely bearish yesterday. But you don't just look at the state of the market as it was. I think we have to dimension what is responsible for this downward slide generally, and you take that from the interpretation, the several interpretations by investors and analysts as it concerns both fixed income market and equity market. The fixed income market is having some kind of vibrancy. We are seeing some improvement in yields here, but those yields are not significant as to depress the current state of the equity market. So that to me means that there are more speculative attacks on the market than what we are seeing in the fixed income market. Again, if you also look at the focus of central bank in the area of the FX market, we have seen that the pusher market, the pusher exchange rate is adjusting upward, and so the remnant of foreign investors in the equity market are taking immediate leap. They are taking a leap for a better shelter somewhere to hide themselves against likely devaluation of the currency. So we have also seen that coming to bear on the market. So all you have seen so far are both expectation on exchange rate, expectation on the environment in the fixed income market, and again, the not too good announcement, the not too good news from government central bank concerning commodity exchanges. So all those things are working against the market at this time. So you can see that clearly, market is under a very serious, speculative attack.
All right, Mr. Olayinka, thank you so much for your input on the program. Tajuddin Olayinka is a stockbroker at Valmont Securities. Now, the market was down 1.96% yesterday, and we dropped to the 40,000 level at 40,696.01 points, while the equity cap was at 21.289 trillion naira. And we saw higher volume and value yesterday. We saw volume at 366.85 million units, worth 5.48 million naira, and all of that was traded in 5,718 deals. Now, the banking sector was down 3.36%. We saw losses from all tier 1 lenders yesterday. GT Bank, Zenith Bank, Access Bank, UBA, they all posted losses. Actually, a lot of lenders posted losses yesterday. Consumer goods was down 0.38%. We saw declines from flour mills and Dangote sugar. Industrial goods was down 3.70%, and that was due to the 7% decline we saw on Dangote yesterday, Dangote cement yesterday. Industrial goods was down 1.15%, while oil and gas was the only gainer for the day. Now, the NSI was on the Onitsha Securities Market was also down yesterday. It was down 0.41% at 739.61 points, while the market cap was at 530.68 billion naira. We saw 677,000 deals worth 65 million naira traded in 7 deals. Now, just to talk more about the fixed income market with me is Caleb Alimi, a fixed income dealer at FSDH Merchant Bank. Good morning, Caleb. Thank you for joining us on the program.
Good morning. Thank you for having me.
Now, we know there was a primary market auction yesterday, and stop rates were higher across all tenors. Could you just tell us more about the turnout of the auction?
The auction was a well-attended one. It was well-demanded, but like we've seen and like you've seen, we saw a spike in rates across the curve. We had the 91-day offer, the 91-day auction closed from 0.55 to close at 1%. We had the 182 days closed at 2% from 1.3%. And we had the 1 year closed at 4% from 2%. What we've seen is, especially on the long end, we've seen a 200 basis point increase at that point, which is also in line with what we saw with OMO auctions the previous week, last week. We also saw OMO auctions, we saw stop rate at the OMO auctions increase drastically. And we expect that this will continue for the fixed income space. Even in the bond market, we are seeing investors demanding higher interest rates due to the fact that the debt management office, the DMO, is expected to continue to borrow more this year to fund the budget deficit. So that's it for the fixed income space.
All right, Caleb, thank you for your input on the program. Do enjoy the rest of the day. Well, Chimi, you heard what Caleb said. If the DMO is going to keep borrowing and we see yields keep rising, we don't know what's going to happen at the equity space.
And then those investors in the equities market, of course, now trying to take position in the fixed income market space, where they can at least even get their quick returns. All right. Anyway, we'll keep monitoring the market, and let's hope and believe that things will turn around in the equities today, since those numbers have really come down drastically. Perhaps people like, I don't know if Ladi is interested in that, but we'll see how that goes. We'll take a break, and then when we come back, we do an opening call to London. And for some updates from the streets of London, let's talk to Juliana. Good morning, Juliana. Good to see you again this morning. Well, the Bank of England governor has warned that there are signs the EU plans to cut the UK off from its financial markets. I guess it's all about Brexit.
Good morning, Chimisa. Yes, it is all about Brexit, unfortunately, and this is a major problem that's probably going to heat up over the next couple of weeks. One of the major gaping holes from Prime Minister Boris Johnson's very late Christmas Eve Brexit deal was the financial services, and the financial services, as well as law, hospitality sector, they account to about 80% of Britain's GDP, and now there are major concerns that EU politicians may want to transfer some of the power that the City of London, the Square Mile have into other attractive cities like Paris, Amsterdam and Frankfurt. Now, the conversation has heated up because yesterday the Bank of England Governor Andrew Bailey gave a statement at Mansion House where he basically said he doesn't want the EU to play any significant games. At the moment, a memorandum of understanding is being drafted up between Chancellor Rishi Sunak and other actors involved on the continent. But there are major concerns coming from the city that this deal may not come into fruition. They are foreseeing that tens of thousands of jobs will go from the capital to other attractive parts of the continent. And he just wanted to make it pretty plain and simple that the EU shouldn't do this, and that if they are awarding equivalents to countries like Brazil, the US, Canada, Australia, then by matter of proximity and because the UK play very much in line with EU rules and regulations, that equivalence should continue. So we have the law of equivalence at the moment. It was temporarily given, but he wants to make sure that it continues in that way when the memorandum of understanding is produced next month, if it is produced.
Right, and KPMG has confirmed that its chairman is stepping aside after telling staff to stop moaning about pandemic. We talked about this yesterday, didn't we? And I thought he apologized already. Did you see this coming?
Nobody saw this come in. Well, I certainly didn't. Bill Michael did apologise yesterday. And I think what's making the story even more shocking is that last year he was hospitalised himself with a severe bout of COVID. But this all stems from a town hall discussion between KPMG consultants and senior execs on Monday. At the start of the call, apparently, this is all allegations, they did an online survey asking staff how they were feeling during the COVID pandemic. An overwhelming majority of staff said they were struggling. And then during the meeting, Michael says that they should stop moaning and they should stop complaining about COVID. Now, depending on, you know, what side of the ladder or you put yourself, there are some publications that are saying, you know, this is the woke brigade being too sensitive. There are others saying that it's absolutely unacceptable. He shouldn't be telling staff that they shouldn't be complaining, especially considering we're going through a pandemic. He obviously did apologise on Tuesday, and then we just heard from KPMG, they said they are conducting an independent investigation and he's decided to step aside from his duties as chair while the investigation is underway.
Okay, so how are the markets holding up this morning?
Yeah, the FTSE's got off to a good start this morning. That's because there's been a slew of corporate updates and they all are pretty favourable. We've had a positive update from Coca-Cola, Uber Eats. Those platforms have been doing very, very well. Their car service hasn't been doing great. People haven't really been going out clubbing and dining. But of course, everybody is at home ordering as much takeaway as they can at the moment. Interestingly enough, we've also had an update from AstraZeneca, the very famous world-leading pharmaceutical giant. They show that their revenues last year were up 11% to £2.6 billion. Sales were up £26 billion. Controversially or not, they have decided not to release details of the vaccine and those sales. They said they're going to wait into the second quarter, which is very interesting because, of course, that's what's made them a household name. And I'm sure that's what's made them even more rich than they were this time last year, Chimmy.
Absolutely. I guess you'll give us more update on those later in the day. Okay, let's look at the crypto market. Ladi, yeah, MasterCard supporting cryptocurrency. Now, is that pumping Bitcoin in any way this morning?
Well, I won't say it's pumping Bitcoin this morning because actually Bitcoin fell about 3% this morning. Market cap still holding strong, $1.365 trillion. 24-hour volume up $219 billion, up 1.57%. BTC dominant still keeps going down. So that's more play for the altcoins. So keep your eye on this number here to know if you should still be holding the altcoins. Price of Bitcoin at this morning, $44,574, down 3%. 24-hour volume, $84.83 billion. Not looking bad. Top five gainers, the altcoins, you see they're playing They're surging. QTUM up 62% in early trade this morning. SNT up 57%. ICX up 51%. Let's talk to Solomon Amonde now. Hello, Solomon.
Good morning. Good morning.
Good morning, Solomon. How is the market reacting to this MasterCard news?
It's doing pretty well. Like, the correction is very much expected. As long as it's between 10% to 25% correction, it's very, very okay. No cause for alarm.
Okay, so what are traders expecting? What altcoins do you think will be supported by MasterCard?
Yeah, first and foremost, we know that Bitcoin will be supported, Ethereum and Litecoin. These are like the oldest, and we expect them to support this.
So that means we should expect some alts, like alts that we don't expect to be on that list. We should expect them surging when MasterCard starts to announce.
Yeah, definitely. But the MasterCard announcement is also based on research since 2013, 2015, and 2019. So most of the alts that are just coming into the market within the past 2 years wouldn't really reflect there for now. We would only expect the ones that have been in this ecosystem for at least 6, 7 to 8 years. So basically, I don't expect to see much of the altcoins there.
What's your outlook for the weekend?
Yeah, my outlook for the weekend is for Bitcoin to trade sideways, at least between the margin of 43,000 and 47,000. We should trade sideways for at least a week to 2 weeks before we head up again to like $50,000 and $55,000.
All right, Solomon Amunde, thank you so much. Solomon Amunde is a crypto trader. Thank you for your time. All right, Jimmy, that's it.
So for people with Dodge, should they be looking at MasterCard support for that currency?
Who knows? Remember, Dogecoin is actually a meme coin, so I don't know if
you
MasterCard
were talking to me
seriously.
about one particular altcoin. You probably
CTSI.
Exactly.
That rallied 200% last night.
What drove that?
Demand.
Yes.
And I told you about the IEO season.
Yes.
That's also one of the Binance IEOs. So they seem to be coming up. Yeah.
Okay, we'll keep tracking that. Thank you very much, Ladi. Well, it's on that note that we draw the curtain on today's edition of the program. Thank you for watching. I'm Chimize Obi Iwagu.
And I'm Ladi Williams. Thank you for watching.